The world's financial architecture is being quietly rebuilt, and most people have no idea it's happening. While economists debate inflation rates and central banks adjust interest rates by quarter points, China has been constructing something far more consequential: a physical infrastructure that could end the dollar's 80-year monopoly as the foundation of global trade. This isn't about currency wars or geopolitical posturing. This is about plumbing, the actual pipes through which money flows, loans are made, and nations finance their development. And China is laying new pipes that bypass the dollar system entirely, using the oldest form of money humanity has ever known: gold. The story begins with a rupture in trust that most Western analysts missed or dismissed. In 2022, when the United States and European allies froze roughly $300 billion of Russian foreign reserves held in Western banks and securities, they sent a message to every other nation watching: your reserves aren't really yours. If we disagree with your policies, we can lock you out of your own wealth with the click of a button. For Russia, this was devastating. For China, it was clarifying. And for dozens of other nations sitting on dollar reserves, it was terrifying. Because if the West could do this to Russia, a nuclear power with significant global influence, what would stop them from doing it to anyone else who stepped out of line? The sanctions against Russia weren't just a punishment. They were a demonstration of power. And demonstrations of power always teach more than their intended lessons. The response was swift but quiet. Central banks around the world, particularly in what are called emerging markets, began diversifying away from dollar-denominated assets. They sold U.S. Treasuries, they reduced their holdings of dollar reserves, and they started buying gold. Not as a hedge or a safe haven in the traditional sense, but as an alternative foundation for a financial system they no longer trusted. The numbers tell the story. For years, central bank gold purchases had been modest and predictable. But starting in 2022 and accelerating through 2023 and 2024, something changed. Central banks became the largest buyers of physical gold in modern history. In 2022 alone, they purchased over 1,000 tons. In 2023, they bought another 1,000. And China led the way. Officially, the People's Bank of China reports holding approximately 2,300 tons of gold in its reserves. But nobody believes that number. China is the world's largest gold producer, mining roughly 370 tons annually, and none of that production leaves the country. China is also the world's largest gold importer, bringing in hundreds of tons each year through Hong Kong and Shanghai. Where does it all go? Into vaults that aren't publicly disclosed, into sovereign wealth funds. Analysts at Bloomberg Economics, JP Morgan, and the World Gold Council estimate China's true gold holdings are somewhere between 3,500 and 5,000 tons, possibly higher. The secrecy isn't accidental. If China revealed the full extent of its accumulation, it would drive gold prices higher before they finished buying, and it would signal to the world exactly how seriously Beijing is preparing for a post-dollar financial system. But accumulating gold is only the first step. The real challenge is making gold functional in a modern financial system. Because for all its historical significance and intrinsic value, gold has always had a fundamental problem. You can't do much with it. You can store it, you can display it, you can use it as a hedge, but you can't easily lend against it, borrow with it, or use it as collateral for the kind of large-scale financing that builds ports, power plants, and infrastructure. That's where Basel III comes in. In July of this year, under the Basel III banking regulations, gold was officially reclassified from a Tier 3 asset to a Tier 1 asset. For those unfamiliar with banking jargon, this is a massive upgrade. Under the old rules, if a bank held $1 billion worth of gold, it could only count about half of that value on its balance sheet for regulatory purposes. Gold was treated as a risky, illiquid asset that needed to be heavily discounted. Under Basel III, banks can now recognize 100% of gold's value, This doesn't just change accounting, it changes incentives. Banks and central banks that hold gold can now use it to meet regulatory capital requirements without discounting it. This makes gold far more attractive to hold in large quantities. But here's where it gets truly significant. Tier 1 status is not the final level. Above Tier 1 is a classification called HQLA, which stands for High Quality Liquid Asset. These are assets so safe, so stable, and so liquid that they can be used as collateral in the repo markets and short-term lending that form the plumbing of the entire global financial system. Right now, the only assets that truly qualify as HQLA are U.S. Treasuries. This is why the dollar dominates global finance. It's not just that oil is priced in dollars, or that trade is invoiced in dollars. It's that the collateral underlying the entire system of international lending and credit is denominated in dollars. When a country needs to borrow money to build infrastructure, when a bank needs overnight liquidity, when a corporation needs trade financing, the collateral backing those transactions is almost always U.S. Treasuries. This creates permanent, structural demand for dollars and dollar denominations. Every nation that wants to participate in the global financial system needs to hold treasuries. And holding treasuries means holding dollars. It's a self-reinforcing loop that has kept the dollar at the center of global finance for years. But what happens if gold becomes HQLA? What happens if nations can use gold as collateral for loans, for trade financing, for infrastructure development, without ever touching the dollar? That's exactly what China is building toward. And the mechanism they're using is something called the Gold Corridor. The Shanghai Gold Exchange, established by China in 2002, is already the largest physical gold marketplace in the world. Unlike Western gold markets, which are dominated by paper contracts and derivatives where physical delivery is rare, the Shanghai Exchange deals almost exclusively in physical metal. When you buy gold on the SGE, you're buying actual bars that exist in actual vaults. This was a deliberate design choice. China wanted a market where gold was real, not abstract. But the exchange itself was only the beginning. Over the past few years, China has been building a network of gold vaults across Asia, the Middle East, and Africa. These aren't just storage facilities. They're nodes in a decentralized custody system designed to solve one of the fundamental problems that has prevented gold from being used as a global reserve asset: trust. When the Bretton Woods system collapsed in 1971, one of the reasons gold-backed currency became impractical was logistics. Gold is heavy, expensive to transport, and difficult to verify. If every country wanted to hold its own gold physically, international trade would grind to a halt. So the system evolved toward paper claims on gold, and eventually toward fiat currency with no gold backing at all. But paper claims require trust. You have to believe that the institution holding your gold will actually give it back when you want it. And as Russia discovered in 2022, that trust can evaporate overnight if the political winds shift. China's Gold Corridor solves this problem through decentralization. Instead of requiring every nation to store gold in Shanghai and trust China to hold it, the network allows gold to be stored in multiple locations across BRICS nations and their partners. Each vault is connected to the Shanghai Gold Exchange through a tracking system that records every bar's purity, serial number, and ownership. Think of it as a physical blockchain, a distributed ledger where the blocks are vaults, and the verification comes from multiple sovereign nations rather than a single central authority. A nation like India or South Africa can deposit gold in a vault within its own borders or in a nearby friendly country, and that gold remains verifiable and tradable through the SGE network. This geographic decentralization addresses the trust problem. You don't have to trust China to hold your gold. You can see it, audit it, and access it yourself while still participating in the broader system. But decentralization alone doesn't make gold functional as a currency or collateral. There's another problem: volatility. Gold prices fluctuate daily based on market sentiment, geopolitical events, and currency movements. If you're trying to use gold as collateral for a 10-year infrastructure loan, You can't have the value of that collateral swinging wildly from day to day. China's solution, according to discussions at recent BRICS summits, is to use a moving average pricing mechanism. Instead of valuing gold based on the spot price at any given moment, transactions and collateral would be valued based on an average price over the previous 200 trading days or some similar period. This smooths out short-term volatility and makes gold behave more like a stable asset, suitable for long-term financing. With these two problems solved, decentralized custody and price stability, gold becomes something it has never been in the modern financial era, a functional alternative to dollar-based collateral. And that opens up a completely new model for development finance. Here's how it works in practice. Imagine you're an African nation, rich in natural resources, but poor in infrastructure. You have gold deposits, mineral wealth, agricultural potential, but you lack the capital to build the roads, ports, and power plants needed to extract and export those resources. Under the current system, you would go to the International Monetary Fund or the World Bank, both Western-dominated institutions. They would lend you dollars, but with conditions attached: structural adjustment programs, austerity measures, economic reforms designed in Washington that may or may not suit your actual needs. Under China's model, you could deposit your gold, or even future gold production, into the Shanghai Gold Exchange network. That gold becomes collateral. The new development bank, which is the BRICS Development Bank, then lends you yuan against that collateral. You use the yuan to hire Chinese construction firms to build your infrastructure. Those firms import Chinese equipment and materials. The project gets built. Your economy develops. And at no point do dollars enter the equation. This isn't theoretical. China has been doing versions of this for years through the Belt and Road Initiative. But those projects were funded with dollar-denominated loans, which meant China was exposed to currency risk, and borrowers were vulnerable to dollar fluctuations. By switching to a gold-collateralized yuan system, both sides gain stability. The borrower knows the value of their collateral. China knows it's lending against real assets, and the entire transaction happens outside the Western financial system. Now multiply this across dozens of developing nations. Africa produces between a quarter and a third of the world's gold, much of it from small-scale and artisanal miners who lack access to formal financial systems. China is offering them a way to monetize that gold without going through London or New York. The Middle East has both gold reserves and oil wealth. Central Asia has minerals and agricultural products. South America has lithium, copper, and rare earths. All of these regions have been trapped in a dollar-based system where they export commodities priced in dollars, hold reserves in dollar assets, and borrow in dollars to finance development. China is it. Not through ideology or politics, but through infrastructure. Physical vaults, verified gold, stable pricing, and yuan-based lending. And critically, the system doesn't require every nation to abandon the dollar immediately. It just provides an alternative, a second option, and once alternatives exist, is broken. The implications for the United States are profound. For 80 years, the dollar's role as the global reserve currency has allowed America to run persistent trade deficits and borrow at artificially low interest rates. The rest of the world needs dollars to function. So, they're willing to lend to the U.S. at favorable terms. This has been called America's exorbitant privilege, and it's worth in economic advantage. But if nations can finance development using gold and yuan, that privilege erodes. Not overnight, but gradually. Countries need to hold as many treasuries. Demand for dollars decreases. Interest rates on U.S. debt rise. The cost of financing America's $36 trillion in national debt becomes more expensive, and the Federal Reserve's ability to print money without triggering inflation becomes more constrained. There's evidence the United States understands this threat. Earlier this year, the U.S. began repatriating gold reserves that had been stored in London for decades. The official explanation involved tariffs and audits, but the timing is suspicious. If the global financial system is shifting toward a model where physical gold custody matters, where nations demand the ability to verify and access their reserves, then the U.S. needs to control its gold, physically, not trust it to foreign vaults. Officially, the United States holds roughly 8,000 tons of gold, the largest reserves in the world. But much of that gold had been stored overseas, particularly in the vaults of the Bank of England. Bringing it back signals that Washington is preparing for a world where gold isn't just a relic or a hedge, but an active component of the financial system. And this brings us to the question of price. What happens to the value of gold if it transitions from a passive store of value to an active financial instrument, used as collateral across a significant portion of the global economy? Right now, major financial institutions, central banks, sovereign wealth funds, and pension funds keep roughly 20% of their reserves in gold or gold-equivalent hard assets. Recent guidelines from analysts at institutions like Bank of America suggest that allocation should be closer to 30% in a world where gold has greater functionality and less dollar dominance. That's a 10% increase. Across the global financial system, that translates to approximately $2 trillion in new demand for physical gold. But unlike dollars or euros, you can't print more gold. Annual gold production is roughly 3,000 tons, worth about $180 billion at current prices. If $2 trillion of capital tries to flow into a market that produces $180 billion of new supply annually, the price has to adjust dramatically upward. Some analysts project gold could double in price over the next 5 years. Others suggest even higher. These aren't fringe predictions. They're based on the structural shift happening in how gold is used. And if gold becomes HQLA, if it's genuinely treated as equivalent to treasuries for collateral purposes, the demand could be even greater. But here's where the story takes an unexpected turn. Because China's gold-backed system and America's dollar-based system aren't the only options emerging, there's a third possibility, one that plays to America's strengths in technology rather than manufacturing or resource control: digital asset. If China is building a financial system backed by physical gold, slow, tangible, and rooted in thousands of years of history, the United States could counter with a system backed by digital asset, fast, transparent, and built on cryptographic verification rather than physical custody. This is where Bitcoin and stablecoins enter the picture. Bitcoin represents many of the same properties gold offers: scarcity, verifiability, resistance to debasement. But it's native to the digital age. It's borderless, instantly transferable, and doesn't require physical vaults or transportation. If the US wanted to offer the world an alternative to China's gold corridor, a Bitcoin-backed or stablecoin-based financial infrastructure would be the logical counter. It would provide the hard collateral backing that builds trust while maintaining the speed and openness of digital networks. This isn't just speculation. The U.S. government has been quietly accumulating Bitcoin through asset seizures and legal actions. Major American financial institutions have been building stablecoin infrastructure, and there's growing recognition among policymakers that digital assets could be strategically important, not just as investments, but as tools of financial statecraft. What we might be witnessing then is not the replacement of one reserve currency with another, but the emergence of a multipolar monetary system. For the first time in modern history, nations and individuals might have genuine choices about what form of money to use. Gold-backed yuan for those who value tangible assets and Chinese infrastructure financing, dollar-based stablecoins or Bitcoin for those who value digital speed and Western technology, and traditional dollars and euros for those who prefer the existing system. This would be unprecedented. For centuries, there was always one dominant reserve currency: the pound during the British Empire, the dollar after Bretton Woods. But technology and geopolitics are fracturing that monopoly. And in a multipolar monetary world, every form of money has to compete on its merits. Gold offers trust through history and tangibility. Bitcoin offers trust through mathematics and transparency. Dollars offer trust through military power and institutional inertia. Each has advantages. Each has limitations. And for the first time, the choice between them won't be dictated by a single hegemon, but negotiated by markets and nations evaluating their options. The investment implications are staggering. If gold is transitioning from a passive hedge to an active financial instrument, its value must rise substantially to reflect that new functionality. If Bitcoin is being positioned as the digital counterpart to gold in a new monetary architecture, its value must rise to reflect that strategic importance. And if dollars are losing their monopoly status, assets denominated in dollars become riskier, while alternatives become more attractive. This doesn't mean the dollar collapses tomorrow. Reserve currency transitions take decades. The pound lost its dominance over 60 years, from 1914 to the 1970s. The dollar's decline, if it happens, will likely follow a similar timeline. But the direction is becoming clear. The world is building alternatives. And those alternatives are being constructed not in abstract financial markets, but in physical infrastructure. Vaults, exchanges, custody networks, and verification systems. China's gold corridor is real. The Shanghai Gold Exchange is operational. The Basel III reclassification of gold has already happened. Central banks are buying gold at record rates. The BRICS nations are expanding, and the United States is repatriating its gold reserves. These are not speculative developments. They are facts on the ground. What remains uncertain is timing. Will gold become HQLA in 2 years, 5 years, 10? Will the BRICS currency unit launch successfully or fracture under the weight of competing national interests? Will the United States embrace digital assets as a strategic counter or cling to the dollar's fading dominance? Will Bitcoin become a reserve asset or remain a speculative investment? No one knows. But what is clear is that the financial architecture built at Bretton Woods in 1944 is being challenged for the first time in 80 years. Not by revolution or war, but by infrastructure. China is laying new pipes. The US is scrambling to maintain the old ones while building digital alternatives. And every nation is watching, calculating, and positioning for a world where money is no longer monopolized by a single power. For investors, the lesson is straightforward. The rules are changing. The assets that dominated the last 80 years may not dominate the next 80. And those who recognize the shift early, who understand that gold is becoming functional rather than decorative, that digital assets are becoming strategic rather than speculative, and that the dollar's monopoly is ending, will position themselves accordingly. History doesn't repeat, but the pattern is unmistakable. Every time the global monetary system restructures, wealth is redistributed, from those who trusted the old system to those who prepared for the new one, from paper promises to tangible assets, from monopoly to competition. The gold corridor isn't just infrastructure. It's a declaration, and whether it succeeds or fails, it has already accomplished something profound. It has shown the world that alternatives are possible. And once people see the alternative, they can never unsee it. The monopoly is broken. What comes next will define the next century of global finance, and the foundation is being built right now. One gold bar, one vault, one transaction at a time.